This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our previous chapter, Chapter 9 on employment income, we saw contributions being made potentially by both an employer on behalf of an employee into what we referred to as an occupational pension scheme, and or contributions being made by the individual employee into their own pension fund there, again under that occupational pension scheme. That is a main type of pension fund that may exist, one that is operated by an employer, known as an occupational pension scheme. A requirement of such a scheme will be, as we've just said, employers are required to make a contribution on behalf of the employee into that pension fund. The employee may have the option of either making a contribution, an employee contribution themselves, or not. What do we see in Chapter 9 about those different contributions? It's referred to here in the notes in front of you, and this is what Chapter 10 is all about, a pulling together exercise, bringing together what we've seen in Chapter 9 and indeed back in Chapter 2 in relation to pension scheme contributions, and adding the required additional knowledge to be able to deal with any such contributions made by an employee or by an employer on behalf of an employee, and establish what tax relief is available to them. Now, in relation to the occupational pension schemes, only available if, of course, you're an employee, only available if your employer chooses to operate such a scheme. I hope you recall from Chapter 9, as we've said, what happened as regards the different contributions. Any contribution made by an employer into the employee's pension fund was an exempt benefit. So there, any contribution by the employer to the employee's pension fund, an exempt benefit. No taxation charges whatsoever. Very good news. Any contribution made by the employee into that occupational pension scheme, into their pension fund, that was an allowable deduction to be deducted in deriving the amount of employment income assessment to then include within the individual's income tax computation. Not all employers operate occupational pension schemes. Not all employers are big enough to be able to do that. So if there is no occupational pension scheme for the employee, or if we're dealing with the self-employed where there is clearly no employer, what are they going to do about providing for themselves in the future a pension? And that is a personal pension scheme and a contribution into their personal pension fund. We dealt with issues pertaining to personal pension contributions back in Chapter 2. So the early parts of this chapter, it's not a very long chapter, you'll be pleased to hear anyway, we're going to be revisiting statements we've already made, initially in Chapter 9, then back to Chapter 2, for contributions made to occupational pension funds and also to personal pension funds there. Once we've reprised that knowledge that we have from those earlier chapters, then we'll push on to see the rather more interesting issues that might be involved here within Chapter 10. So what have we got? Employees, as we've just said, may join an occupational scheme set up by their employers. And or, of course, the employer may not have one, but if they do have one, they can still, as an employee, make contributions into a personal pension scheme that will be arranged by the individual directly with the pension provider, an insurance or assurance company being the most usual ones that we see there. If, of course, you're self-employed, then there is no occupational scheme, and all the individual may do is to join their own personal pension scheme. To encourage individuals to join a pension scheme, as we will discover, generous tax reliefs have been provided. We've already mentioned two of those tax reliefs. Any contributions made by an employer into the occupational scheme of the employee is an exempt benefit. It could be several thousands of pounds paid by the employer into the employee's pension fund. An exempt benefit there. and any contributions made by the employee out of their employment income into that self-same pension fund, well, that would be an allowable deduction to be deducted in deriving the net employment income of the taxpayer, as we said, to then include on the income tax computation for that individual. As we also said here, and returning to the notes, that these schemes will always have contributions made into them by employers. That's a basic requirement. And may also have contributions made by the employee. There's no limits on the amount of contribution that may be made by the employer, but they will count towards, now here's something we haven't seen before and going to be an important issue in this chapter. They will count towards the employee's annual allowance. We've said up here that there are generous tax reliefs available. We've illustrated that with the employer contribution, with the employee contribution into an occupational scheme. But the generosity of HMRC has limits. And what they will do, therefore, is to limit in relation to any contributions made either by the employee and or by the employer. We will have a limit placed upon how much of any of those contributions will achieve tax relief in any given tax year. And that's where this annual allowance, so-called, comes into play. So any of these contributions count towards the individual's annual allowance and the value of the fund for the lifetime allowance. See section 2. The lifetime allowance is, again, just a basic statement of fact that in relation to when you take your pension, if you have accumulated a fund in excess of the lifetime allowance, then there are penalties that will be imposed in terms of extracting the pension income, or indeed the capital, from that pension fund. Those rules are not within the syllabus, so it isn't something you need to worry about. You simply have to be aware that there is a figure of lifetime allowance, and we'll talk about that later. The contributions made will be tax deductible for the employer. Any contributions made by the employer, allowable deductions. So look at the benefits in terms of a tax system. Those employer contributions are exempt benefits for the employee. There's no income tax, there's no national insurance contributions to be charged in relation to those contributions made to the employee's pension fund by the employer. And the amount paid into that pension fund on behalf of the employee is an allowable deduction when it comes to preparing the company, the employer's, corporation tax computation. That's an allowable deduction, attracting tax relief to the company in the accounting period in which they are paid. So the company makes the contribution, it gets a reduction in its profits that will then be charged to corporation tax. The amount paid over is an exempt benefit, no taxability on the employee. And then if the employee tops it up with their own contributions, those are allowable deductions. Having said that, what we will also come to just a little bit later in this chapter is the fact that, as we said, HMRC's generosity is limited, and that's where this so-called annual allowance comes into play that may limit the actual amount of tax relief that the employee, the individual, benefits from in any tax year. As we've said there, contributions made by the employer are exempt benefits for the employee, though may contribute towards an annual allowance charge. Yeah, we said we had an annual allowance. Again, this comes in a later section in this chapter. But if you go above your annual allowance, a figure by its name that is available for a year, but we'll also discover that we may have brought forward unused annual allowance from earlier years, as many as the previous 3 years in point of fact, as we'll see within these notes, that if we go above what we're allowed for any year, the annual allowance of the year plus any unused annual allowance brought forward from the previous 3 years, we've gone above that, then there may be an annual allowance charge, where basically that excess is going to be charged at the bottom of your income tax computation at whatever is your marginal rate of tax, treating it as non-savings income. But again, we'll talk all about that later. And of course, these amounts of contribution paid, not chargeable to income tax and not chargeable to NICs either. We look at NICs, National Insurance Contributions, in Chapter 11. Right, before we get stuck into worrying about how this annual allowance applies in relation to the total pension input, the total contributions made in a tax year by the employer, by the employee, we've got to look to begin with upon what amount of those contributions will initially attract tax relief, subject to the further limitation of the annual allowance system. So to begin with, contributions made each tax year by an individual into a pension scheme will attract tax relief, but limited to the higher of. So here's a lower figure, £3,600 of gross contribution. So the lowest amount that may be contributed into a pension fund on behalf of an individual and tax relief be given upon it is a gross contribution, more of what we mean by that expression later, of £3,600. It is hugely likely that in most circumstances, individuals will have a much greater capacity than just £3,600 of gross contributions, because it is the higher of that 3,600, or, here's an expression we need to know, the relevant earnings of the taxpayer. Relevant earnings. What are relevant earnings? Well, you might guess there in relation to what we've covered so far. Earned income. What is earned income there? What is, again, the two main sources of earned income? They are, of course, employment income, as we've just seen in Chapter 9, and or, if you're self-employed, trading profits for the unincorporated trader. There's one other possibility, plus any profits from furnished holiday lettings. You might want to go back and look at Chapter 3 there in relation to property income and how, if you have furnished holiday lettings, the tax treatment of such income is slightly more beneficial than it would be for any other form of property income. Here is one example of that. It counts as relevant earnings. If you are looking to maximise the amount of contribution you can achieve tax relief on in any tax year, then those furnished holiday lettings, property income, that's going to be part of your relevant earnings. But for the vast majority of taxpayers, it's simply your employment income, assessment, or your trading profit there. Okay, so there's your first exercise in relation to contributions made each tax year by the individual into the pension scheme, establishing what amount will be the allowable figure. The lowest it could be is 3,600, and there is no upper limit there in relation to the relevant earnings. That depends on what employment income and or trading income and or furnished holiday letting income that you have. That said, what we'll come to later is if those amounts rise and go above your annual allowance for the year, and above on top of that what unused annual allowance you have brought forward from the previous 3 years, then you may end up with a tax charge, an annual allowance charge. But again, more of that later. As we've just said, this amount will contribute towards the annual allowance permitted each year. Right, now we've been referring to, and we'll focus on just for a moment longer, an occupational pension scheme, one that is run by the employer on behalf of the employees. When an employee makes a contribution into such a scheme, tax relief is said to be given at source under the so-called net pay arrangement. Now, you may not remember what we did in Chapter 2 as regards personal pension contributions. I'll be going back through that with you in a short while. But that's got nothing to do with this. This net pay arrangements is just a name by which the administration of the system is pursued. The employer will deduct the gross contribution from the individual's employment income before computing the tax to be deducted under PAYE. At the end of the previous chapter, you may have read about the pay-as-you-earn system. You may be saving that for a later point in time. As again, with most admin, it is something that needs to go into the short-term memory just prior to the exam and then regurgitated in the exam room. But what we have there is the situation where if I had a salary of £40,000 and I wanted to put 10% of that, £4,000, into my occupational pension scheme fund, then my employer, on behalf of me, would take out £4,000 taken month by month over the tax year, totaling £4,000, and put that into the pension fund. What it would mean in terms of how they operate the pay-as-you-earn system, instead of each month taking 40,000 divided by 12, and that's my monthly salary. For PAYE purposes, what is to be taxed through the pay-as-you-earn system, the 40,000 salary that I have would be reduced by the £4,000, this contribution made by me into my pension fund. So effectively, I would be treated as having a salary of 36,000. So each of the 12 months, £3,000 annual salary would go through the PAYE system, the net amount of my salary after deducting my employee contributions. And we illustrate that here with a further example. If, for example, we had a gross annual salary of 25,000, you want to contribute £1,000 into your occupational pension scheme, the employer over the tax year will pay £1,000 into the pension scheme and put hence the term net pay, salary of 24,000 I should say, through the PAYE system. It is as if my salary was 24,000 rather than 25. A moment ago, it was as if my salary was £36,000 for tax purposes instead of £40,000. We deduct those employee contributions from your salary month by month, and only the net amount goes through the PAYE system to be charged to tax. So you effectively get your tax relief by never being charged to tax on that part of your salary income in the first place. Tax relief will be fully available as the gross contribution does not exceed £3,600. Here again, £1,000 into the pension scheme. Clearly, that does not get anywhere near the £3,600, which is the minimum level that all taxpayers, all individuals, would be able to put into their pension scheme. If, of course, you are doing your income tax computation, as we saw in Chapter 2, and as we then dealt with the detail for employment income in Chapter 9, then in your income tax computation, what is your salary? It's £25,000, less a pension contribution of £1,000. So on your employment income assessment, on the face of the income tax computation, you would be showing 24,000. But where did it come from? It came from a gross salary of 25 less the employee pension contributions of 1,000, giving you £24,000. That is what you'd be taxed on, but we include the gross, take away the pension contribution. Okay. That's how we deal with occupational pension scheme contributions made by employer, exempt benefit for the employee, and an allowable deduction for the employer, usually the company there, in determining the profits chargeable to corporate tax. The employee contribution, an allowable deduction from their employment income. How do we effectively get our tax relief from a practical perspective through the pay-as-you-earn system by the so-called net pay arrangement? What we've seen is that the amount of contributions made by the individual each year can at least be £3,600 in relation to achieving tax relief. It is likely that their relevant earnings will be significantly greater than that. Your employment income, your trading income can be probably well above 3,600. So your relevant earnings, therefore, would represent, to begin with, the maximum amount of contributions that go into your pension fund. That, however, may then further be limited by reference to our annual allowance, More of that later. Right. We focus there on occupational pension funds and occupational pension scheme contributions. If you are self-employed or you're an employee, but your employer doesn't operate an occupational pension scheme, there's nobody else to look after you in relation to a pension, you have to enter into your own personal pension scheme. So where an individual contributes into a personal pension scheme, then, now this takes you back to Chapter 2, we'll test out now whether you've remembered it, no such deductions are made from income on the computation. So whereas an occupational pension scheme contribution made by an employee into their pension fund reduces the employment income to include on the face of the income tax computation, personal pension contributions, no deduction. So we never ever deduct those figures in deriving the taxable income of the taxpayer. So what do we do instead? I wonder if you remember that. The line that we used was that basic rate tax relief was given at source. Now what does that mean? It meant that if a taxpayer paid £8,000, say, into his or her pension fund, then that payment is deemed to be net of basic rate tax relief, basic rate of tax 20% in relation to non-savings income, deemed to be net of basic rate tax at 20%. HMRC will then pay the pension provider an amount equivalent to the basic rate deduction. If your net is £8,000, after 20% deduction has applied, 20/80ths of that £8,000 would be £2,000. Thus, the individual's pension fund is increased by £10,000 in total. You imagine you had £10,000 of your income that was subject to basic rate tax at 20%. That would leave you with net income after tax of £8,000. And you've taken that £8,000 of your net income and put it in as a contribution into your personal pension fund. What HMRC then say is, if you've put that £8,000 net amount of income, after we've already deducted our basic rate tax on that part of your income, that would have been £10,000. We deducted £2,000 income tax. You put £8,000 then into your pension fund. Well, I tell you what, we'll now put that £2,000 tax that we deducted from you as a separate payment into your pension fund on your behalf. So you will get both the £8,000 you put in plus the basic rate tax relief given there on the remaining £2,000. So your pension fund will be credited with a grand total of £10,000. As that gross contribution exceeds £3,600, we've seen that, of course, is a minimum figure that would always be allowable. Then the taxpayer must have net relevant earnings for the tax year of at least £10,000 for tax relief to be fully available there. And even if we do have relevant earnings, which we are likely to have in excess of that, there's still the possibility that there may be a further limitation in tax relief due to the annual allowance being exceeded for a tax year. So, personal pension contributions, basic rate tax relief given at source. I've explained how that works, but for you in an exam question, preparing an income tax computation, there's nothing to do. There is no deduction in relation to personal pension contributions to go through your income tax computation. So all you do is to include your trading income or your employment income on the face of the income tax computation. No deduction therefrom, because your pension fund has been credited with the amount of basic rate tax that HMRC took from you on that gross amount of your pension contribution. So they put it into your pension fund. So there's nothing for you to do if you are only a basic rate taxpayer. But what we learned back in Chapter 2, and if you cannot now recall it, I would strongly advise you go back and look at this in Chapter 2, is that we are much more likely to be dealing with a higher rate taxpayer, if not even an additional rate taxpayer. But it's only basic rate tax relief that is given at source. So how does the taxpayer end up, if they're a higher rate taxpayer, getting their higher rate tax relief, if they're an additional rate taxpayer, getting their additional rate tax relief? How do they get that? Now again, if you remember what we did in Chapter 2, you'll know the answer to that. And that is that we have an extension of the basic rate band for higher rate taxpayers and of the higher rate band for any additional rate taxpayers. See what this note reminds us of. Higher rate and additional rate taxpayers achieve higher and additional rate relief by extending the basic and higher rate bands. We extend those bands. The basic rate band that would have been 37,500, the higher rate band that would have been 150,000, they are extended. They're extended by the gross amount. The gross amount, cross that out rather than underlined it, by the gross amount of the personal pension contributions. So in this example, the higher rate and the additional tax rate bands will increase by, now what we said, you made a net contribution, what you, the employee, the individual rather, actually put into your pension fund, your personal pension fund, was £8,000. Then the gross amount of that was 10,000, 8,000 times 100 over 80, grossing up for the 20% basic rate relief given at source. That will be a gross figure of £10,000. So, higher rate, additional rate bands increase by extending those bands by the gross amount of the pension contribution, so that higher and additional rate tax will only arise above taxable income figures of, so, £47,500 instead of basic rate tax band stopping at 37,500. We extend it by 10 to 47,500. Instead of higher rates stopping at £150,000 of taxable income, we go up to 160,000 there in relation to the 40% higher rate. We extend our basic rate bands and, if necessary, higher rate bands by the gross amount of the personal pension contribution paid. Remember that the gross amount of personal pension contributions are deducted in deriving the adjusted net income figure. So as a separate issue here, again back in Chapter 2, we saw that if an individual's adjusted net income were to exceed £100,000, then there was a problem for that individual. Okay, not too much of a problem given that you've got a lot of income. But your tax problem was, as you went above an adjusted net income figure of 100,000, you started to lose the availability of the full personal allowance. You lost that personal allowance on a basis of £1 for every £2 worth of income in excess of the £100,000 income limit. Again, a figure given to you on your fact sheet in your rates and allowances page in the examination. So the gross amount of personal pension contributions are deducted in deriving the adjusted net income figure used to determine any reduction in the personal allowance of the taxpayer. So we've now seen the different ways by which we may have to deal with pension contributions made by an individual whether into an occupational pension scheme or now into a personal pension scheme. We've equally seen that if you are a member of an occupational pension scheme, there must be employer contributions into that fund as well. And we know how to deal with that, not just for the individual, the employee, it is an exempt benefit, but also for the company making that payment, it is an allowable deduction against their trading income. It will reduce their taxable profits. So in an exam question, we must firstly identify, are we dealing with personal pension contributions or are we dealing with occupational pension scheme contributions? We also have to be aware how much of any such contributions will achieve tax relief. As we've seen to begin with, we'll take a figure that is the higher of a gross £3,600 or your relevant earnings, basically your employment income and or your trading income there. That said, there may be still a further restriction as regards the amount of those contributions that effectively receive tax relief if you end up exceeding your annual allowance, an annual allowance that may be supplemented by any unused such annual allowance brought forward from the previous 3 years. But that is something that we'll see in this next section here. Okay, well, before we move on to section 2 and deal with that annual allowance, again, make sure you've gone back to chapter 9 where we dealt with the pension contributions made by an individual employee into their occupational pension fund and contributions also made by the employer. Go back to chapter 2 where we saw how to deal with personal pension contributions. It was the same tax treatment as we had for gift aid payments. Hopefully we recall that. But if there is any doubt, you go back and deal with those issues first. Otherwise, we're not going to understand what we move on to in our next session together here when we deal with the annual allowance and potentially, based on that, the annual allowance charge. So check those issues out from chapter 2 regarding personal pension contributions and chapter 9 on employment income, dealing with the pension contributions made by both the employee and or the employer into what was there an occupational pension fund. Next time, we'll look at what is this annual allowance and what happens if you exceed that annual allowance with the amount of contributions that you have made. Does it mean that you end up with this so-called annual allowance charge?